Hey, welcome everybody to the 40 Finance channel. Here we are on November 18th, and it feels like the stock market is slipping a little bit. There's definitely been a lot of solid stocks that have had pretty good earnings that have just sort of melted out, and it's turning into, at least this week, kind of a market of haves and have-nots. You've got these EV stocks with crazy valuations that continue to go up. You've got NVIDIA, which, credit to them, they had a really good earnings report, but their valuation is starting to stretch into the stratosphere. And meanwhile, there's a handful of really good companies out there that provide solid fundamentals that the price continues to drip down. From my perspective right now, I think it's important, if you are buying stocks, probably to focus on fundamentals, especially EPS, if you can, or growing EPS in the future, because you just want to have those valuation fundamentals on your side if this thing goes down much further. And perhaps more importantly, as we look ahead to the future and uncertainty with interest rates and all those things, if you have fundamentals on your side with the stocks you own, the floor starts to get a lot higher. It sets up a strong foundation. And if you're looking long term, then you can probably still feel good that 3 to 5 years from now, you're going to be in the green. So today I'm going to pick through a few stocks that have growing EPS, growing revenue, and sit below or near where Morningstar attributes their fair value. All right, to kick things off, let's start with the stock screener here on Yahoo, and looking for United States stocks because that's where I live. Market cap, mid, large, and mega. Again, for myself, I'm trying to stay away from these small caps right now because it's been a rocky road for my small caps, I'll tell you that much. And even mid caps, I think you really have to stare at them and make sure that you feel good with their underlying fundamentals. It doesn't necessarily mean they have to have strong fundamentals today, but I do think you need to think about how quickly they can grow into a reasonable valuation going forward. Price over $5 just as a starting point to get rid of penny stocks. We want to see estimated revenue growth of 20% or more and estimated EPS growth of 20% or more. And as I looked at that, I actually changed it to 19 because it's greater than. So greater than 19% on both sides gives us 171 results. I like to sort by market cap because I think we're looking for stability right now. At least that's what I'm preaching. So the larger the market cap, I would argue the more predictable the stock becomes because you have more analysts, you have a longer track record in most cases. So that's just my 2 cents, but I do think large caps make a lot of sense if you're buying individual stocks right now. We have Google to kick things off. Let's take a look at where Google sits. And Google just had an outstanding earnings report. We look at the 1-year chart. I mean, it's just been a nice run up for Google. And if you look off to the side, it's kind of nice. Yahoo started putting the Morningstar rating right on the page if you're a Yahoo Plus member. And what we see here is a fair value of 3,400 and an economic moat of wide. I see that doesn't show up in the screen. I'll adjust that for the next stock. So you got a wide economic moat. You got, arguably another $400 to run over the next 12 months or so. So if you do see Google become part of this meltdown at any point under $3,000 and you think you're going to be in for a couple years, the valuation is certainly there. You got a trailing 12 months P ratio of 29, which is not bad when you see some of the other things that are out there. All right, next up we've got Amazon. This is stock that I own. And for Amazon, it has not been the straight line up that Google has seen. However, you're still up about $600 over the past 1 year. If we look at the Morningstar rating, we've got a fair value of $4,100, economic moat of wide, and the P ratio trailing 12 months is 71.09. Now, if you haven't been following Amazon, they have announced that they're pouring a ton of money into logistics. particularly on the e-commerce side. So that has spooked a lot of investors because they're spending literally millions and millions of dollars to improve how they get packages faster to customers. In my opinion, in the long run, this is going to make a huge difference for Amazon. So I like the move, but what you have seen is this EPS number, the projections for it have actually been coming down. Now, the projections for next year are still solid, but you could see another year of roughly flat on Amazon. When I bought in, my expectation was that the stock goes to around 4,000 or so, something like that, heading into the first part of the next year. I'm not sure it's going to happen that quickly with as much money as they have to spend, but we'll see what they can do in Q4 to help kind of make some return on the expenditures on the distribution side. Obviously, on the back end, you have Amazon Web Services that continues to grow. So I still like where I'm at on Amazon as far as getting in later on this one. I'm in about $3,100, $3,200. And it's just one of those stocks that, frankly, I would definitely add under my cost basis, but I'm just planning on holding it for the long run. I think it offers some safety and still has a high ceiling ahead of it. All right, back to the screener. Tesla's on here, but let's see what the difference is on Tesla. Now, Tesla continues to just grow and grow and grow. Everyone who's gotten in Tesla has seen handsome rewards, but in terms of would you buy it today at $1,100, for the long term, there's a lot of people who would argue absolutely yes. On the Morningstar side, though, you've got a narrow moat, and you've got a fair value of $680. Now, to be fair to everyone who's held a Tesla share, the fair value of Tesla or the predicted value of Tesla from any analyst has essentially been wrong for 2 years now, right? So I get it, particularly if you've been in this one for a long time. Personally, I still think at $1,100, there is probably more risk to the downside, but let's be fair. This stock has posted win after win after win. I've thought that the downside has been inevitable more than once, and it continues to outperform. So not one that I'll be buying, but I certainly wouldn't blame anyone who gives it a shot. All right, next up we have Facebook/Meta. And the 1 year on Facebook, it's always a little bit of a circus act with Facebook because they're under so much scrutiny from so many different government and consumer safety organizations. So right now you've got a trailing PE of 24, which is pretty unbelievable when you think about how much money this company makes. And over the past year, you've gone from 269, the high was 278, you're down a little bit to 339. On the Morningstar side, fair value of 404, economic moat of wide. I guess the question that you have to ask yourself as an investor for Facebook, do you believe in the metaverse, Web 3.0, whatever it is that they're investing in? With as much cash as they have, frankly, it's not the worst bet in the world, in my opinion. Unfortunately, I'm just not very well versed in the things that the business is shooting for. So I like Facebook's valuation. It's one, though, that I'm not familiar enough with the long-term plans to get behind it yet. All right, Netflix is on here. I like Netflix. However, it did just have a super run-up from 500 up to 686. This is a stock that I actually purchased for my mother's retail trading account that I manage for her, and it's been absolutely phenomenal. But I bought that at like $475 this year when I was preaching to you guys that Netflix was probably undervalued. On the Morningstar side, though, they've never been a huge fan of Netflix. So they have a fair value of $275, economic moat of narrow. I still believe that Netflix has the content tools to grow for a very long time and to basically be the foundation of streaming for a very long time. I think the performance of Netflix moving forward is being miscalculated by almost every analyst we'll see what happens. All right, JD.com. This is a Chinese stock, e-commerce platform. You're actually down, is that right? You're down for the year, maybe by $1 or $2 over the past 12 months. Morningstar, $111 fair value, economic moat of wide. And while we're here, let's just click on Alibaba because they've made a ton of headlines for basically leaking out their value, and there's a lot of people in the Alibaba bull camp. I don't traditionally buy Chinese stocks as standalone names. I have owned the KWeb China Internet Stock ETF in the past. I was lucky to sell out of that before this meltdown happened. But it is interesting. Alibaba came out yesterday or this morning with sort of a subpar earnings report. And you got to wonder if this is a once-in-a-lifetime deal here for an e-commerce powerhouse in China. $144, fair value over at Morningstar of $284. It's a 5-star stock with an economic moat of wide. It's starting to get intriguing even for me at this point. All right, let's hit ServiceNow. See what they got going on. And this one has had a pretty good performance over the year for investors. You're at 518, now you're at 678. P ratio of 622, so not a ton of EPS on this one. However, Morningstar gives it fair value of 685. Economic moat of wide. Let me see what they're projected for next year. You've got an EPS this year of 592 projected to grow to 723 next year. And sales numbers, 29% this year, potentially 25% next year. So there's something here. I would argue that it's not necessarily on sale right now, but if you saw maybe a broader market dip and you like this company, it could be an opportunity. All right, now I'm just going to skip ahead to some that I've mentioned before that I'm watching myself here. MercadoLibre, so very similar to Alibaba, except for South America. And what you have here is a stock that really hasn't moved at all since November of 2020. So you're at roughly 416. Today you're at 14.4. And it's almost like Amazon, right? So there's a lot of bull cases for Melly, but they have yet to really see their stock price go up. I personally think that they're probably a headline or a stock split away from going up a little bit. However, they did just announce that they're doing another stock offering, so there's going to be a little bit of dilution involved there. Morningstar still has fair value at 1760. Economic moat of wide. There's definitely a chance I get into the stock. It just hasn't really hit that no-brainer price for me yet. And the addition of the dilution news here recently has made me a little bit more jittery. However, if you look at this EPS growth into 2022, granted their projections, they still have to do this, they are reaching a cycle of profitability that's fairly impressive. So if they do get to 841, that PE comes down substantially, and you're still looking at year over year of 75% growth and plus 30% going forward. Melly is definitely one that's on my list. All right, let's take a look at Cloudflare because Cloudflare has been in the news a lot. It's sort of a popular stock, I would argue. And the thing with Cloudflare is you see this huge run up. Last year at this time, you're at $66. So they've basically 3x'd it. And on the Morningstar side, you kind of see, 1-star rating at this price. It doesn't mean that the stock or the company is bad. That rating just means that the price is a 1-star. It's simply not attractive in Morningstar's eyes. Fair value of 150. Does have a narrow moat, which is good. And it is growing very fast, but even next year, your EPS is a penny if they hit that. Now, your sales are growing quickly, but they're not at $1 billion yet. It's just really hard to find the case for Cloudflare at this particular price, particularly if you're trying to protect against the downside during uncertainty. I could see even the smallest little issue come up for this company and the stock price is going to drop, 25% or so, not because the long-term headlines change, just because the valuation is so high right now. All right, same thing for another stock that I used to own, and that is Unity Software. Now this one I sold out when it went on a major meltdown. So it started off 2021 at 150 or so, and then this is my life right through here all the way through May, just melting. Now it's back up in high favor. Morningstar has a fair value of 150. The economic moat, though, of none. This is something that I've been thinking about a lot with Unity. I would probably give it another chance on some negative news if the price came down from here, but it's going to be very similar to Cloudflare. No EPS to rely on, even into next year, so you're going straight sales. And this is a company whose sales will drop, the growth rate anyway, will drop to about half of what they did this year. All right, let's look at Twilio. Last year at this time, you're at 298, so it's turning into a net loss for 12 months for stockholders who have hung on that long. Morningstar loves this one. 4-star price, 388. And what's interesting, they're not that different than Cloudflare and Unity, though. You're not going to get that EPS, so minus 3 cents next year if projections are correct. But what you do have is plus 50% revenue growth this year, plus 30% next year. So I'm attracted to it from the standpoint of where analysts and Morningstar think the price should be. Just for me, I worry about the fact that it doesn't have a positive EPS to fall back on. I just don't know if we're going to return to a value-orientated stock market. If you don't have an EPS, then you're really starting to fall into some of those more obscure categories like price to sales, enterprise value, which has a market cap segment to it. So as things fall, you can get yourself in a bad place. I wouldn't blame anyone for picking up Twilio under $300. For me, though, I need to see a bigger price break. All right, let's pick off another one here, Palantir. This one's come down. Always talk of dilution in this company, and you should be about net zero. Yeah, well, it was $18 last year at this time. You're at $21.70. I believe my cost basis on Palantir is $22. On the bright side, you have fair value of $31 in Morningstar, 4-star rating. So very interesting, because a lot of the bears with Palantir would say, hey, highly diluted stock, long runway to go. I can't really argue that. The only thing I'm going to point to, though, is we could reach profitability, although only 15 cents, perhaps 20 cents next year if they get lucky. And, I just don't think you buy this one unless you've got 5 years in it. So 40% growth this year, 30% growth next year. We know that in software, once you get established in companies, it becomes very, very hard for them to turn to other companies because you just have so much time invested. Certainly, if it gets under 20, I will definitely add, and I might buy a couple shares here or there to go with mine since my cost basis is slightly higher than this price right here. All right, let's hit another popular stock on my watch list, and that is SoFi. I know a lot of the folks who join me on live streams, they like SoFi. I've been watching it. I like it too, but I really thought it was going to keep dripping out when it was down here in the teens, and that hasn't happened. In fact, it made a strong run to 22 or 23 after a good earnings report. Seeing some weakness here, so I may have to jump in on this next opportunity Morningstar has $22 fair value for this one. Similar to Palantir, there's not a lot with the EPS as of yet. Perhaps next year they get closer, but this is the number that everybody's going on, 46%. My argument, I guess, is at this price, it's definitely worth a shot. Morningstar typically is not going to give a fair value like this to a stock that, that they don't see the future being bright. Call out though, there is very little economic moat here, so SoFi will have to continue to innovate to distance themselves from competitors. All right, I'll throw in one bonus one here that I've been studying a lot lately. This is ticker symbol PAGS. It's PagSeguro, I'm guessing. I don't even know how to say it. But basically, you're looking at a fintech operator in Brazil who not only does, it's basically a square of Brazil, okay? Because they also have the consumer-facing app, similar to Cash App or Venmo, that they're working on. It's getting blown out of the water here recently. You can see in September, this one was 56. Now you're at 31. And a lot of the concern on this price has been the fact that the exchange rate or the fee that they're charging customers has been capped by the government. So people are like, oh, well, this can't grow. And at least if you read the stuff I've been reading, the insinuation is they don't need that charge to go up, just to increase margins. They can simply just get more people. And that's the part about Brazil that's very undeveloped. So I'm looking at this one. It passes the Morningstar sniff test with a fair value of 34. You're at 31 today. I'll do a full review of this one if I do end up buying it. But I just want to tell you guys it was on my screen. All right, guys, so we picked off a handful of stocks there. And I think, like, for me anyway right now, protecting against the downside is very big, just with these moves that we're seeing in the market. From my side, I'm focusing on only companies that have EPS growth, only companies that have revenue growth into the double digits for next year, and ideally for the long term too. And then we're just trying to get some opinions, whether it's Morningstar fair value, analysts' opinions, just trying to really study and get a feel for what is this price today, what could it be in the future. I think that we're reaching a point now heading into 2022 where some of the blind dart throws are not going to work as well. So make sure that you at least pay attention to fundamentals. You want them to be on your side. If the market does come down, at least you'll have a standard valuation metric to help pull your stocks up over time. All right, guys, hope you enjoyed this video. Thanks as always for watching. Please give a like, subscribe, all the things. We'll see you on the next one.